Bill spent the last 15 years of his working life building what he proudly called his income portfolio, concentrating his investments in stocks paying dividend yields of 5% or higher, utilities, tobacco companies, aging telecom firms, convinced that collecting regular cash payments was the safest, smartest way to build wealth without ever needing to sell a share. His sister-in-law Carmen, investing the same amount over the same period, ignored dividend yield entirely and simply bought a total stock market index fund, a mix of thousands of companies regardless of whether they paid dividends at all. When they compared retirement account statements at a family gathering after both had invested for 15 years, Carmen's account had grown to nearly 40% more than Bill's, despite Bill's portfolio having paid him consistent dividends the entire time that Carmen's fund mostly hadn't. This surprises a lot of people who've absorbed the idea that dividend-paying stocks represent a safer, more disciplined form of investing, generating tangible cash rather than relying on a stock price that might or might not go up. The appeal is genuinely understandable. A dividend check feels like proof the investment is working, in a way that an unrealized gain sitting on a screen doesn't quite match emotionally. But the math underneath dividend investing reveals something most high-yield dividend investors never fully account for, and it's a big part of why Bill's 15 years underperformed his sister-in-law's by such a wide margin. The first issue is what's sometimes called the dividend irrelevance principle, and it's one of the more counterintuitive facts in investing. When a company pays a dividend, its stock price drops by approximately the amount of that dividend on the payment date, because the company has literally just sent that cash out the door, reducing its own value by the exact amount distributed. A dividend isn't free money generated on top of a stock's existing value. It's simply the company converting a portion of your own investment from unrealized stock value into cash, handed back to you, often in a way that triggers an immediate tax bill you wouldn't have owed if the money had simply stayed invested and grown as share price appreciation instead. That tax difference is the second, and often larger problem with Bill's approach specifically. In a standard taxable brokerage account, dividends are taxed in the year they're received, whether or not the investor wanted or needed the cash that year. Carmen's index fund, holding many companies that reinvest profits into growth rather than paying them out, generated far less in annual taxable dividend income, allowing more of her money to keep compounding, untaxed, until she eventually chose to sell shares herself, on her own schedule, often at a lower long-term capital gains rate. Bill, by contrast, paid taxes every single year on dividend income he frequently didn't even need yet, money that was then unavailable to keep compounding inside his own portfolio, a quiet, repeated tax drag that Carmen's approach mostly avoided. The third issue is concentration risk hiding inside the safe income framing. Companies offering unusually high dividend yields, well above the broader market average, are frequently paying those elevated yields because their stock price has already fallen due to weakening business prospects, not because they're unusually generous or stable. A 7% or 8% dividend yield is, in many cases, the market signaling that investors expect trouble ahead, sometimes including a future dividend cut, rather than signaling a uniquely reliable income stream. Bill's portfolio, concentrated heavily in a small number of high-yield sectors, carried far less diversification than Carmen's broad index fund, and several of his highest-yielding holdings did eventually cut their dividends during the 15-year stretch, reducing both his income and his principal at the same time, the exact outcome his strategy was supposedly designed to avoid. None of this means dividend-paying companies are inherently bad investments, and plenty of high-quality, stable businesses do pay reasonable, sustainable dividends as part of a broader, well-diversified portfolio. The mistake isn't owning dividend stocks. It's specifically chasing unusually high yields as a strategy in itself, treating yield as a proxy for safety or quality, when historically it has frequently correlated with the opposite, and ignoring the tax inefficiency that comes with generating large amounts of taxable income you didn't specifically ask for or need. There is a real, legitimate case for prioritizing dividend income, and it applies clearly to a specific kind of investor, someone already retired, drawing down a portfolio for living expenses, who values the psychological simplicity of spending dividend checks rather than manually deciding which shares to sell each month. For that investor, dividend income solves a real behavioral problem, the discomfort many retirees feel about selling shares of a portfolio they've spent decades building. Even when selling shares to generate the exact same amount of spending money would be mathematically identical or better. The value there is behavioral and psychological, not a genuine mathematical advantage, and it's worth acknowledging honestly, rather than dismissing. The investors who avoid Bill's outcome generally aren't rejecting dividends altogether. They're simply refusing to let a stock's dividend yield become the primary factor driving what they buy, understanding that total return, price appreciation plus dividends combined, is the number that actually determines wealth, and that total return has historically been the domain of broad, diversified portfolios, far more often than concentrated, high-yield ones. Chasing yield specifically, rather than total return generally, is where the strategy quietly breaks down. Bill, looking back at his 15 years, still describes the dividend checks as satisfying in a way he genuinely misses, a tangible reminder that his money was doing something. Carmen never had that same monthly reminder. Her portfolio simply grew in the background without announcing itself the way Bill's dividend deposits did every quarter. But when the two accounts were finally compared side by side after 15 years of identical contributions, the quiet, undramatic index fund that never once handed Carmen a check had outpaced the portfolio that spent 15 years proudly paying her brother-in-law regular income by nearly 40%.